Welcome to video 8 in the Coronavirus and Capitalism series. I'm still on lockdown, enjoying quality time with my house. Through these videos, you've gotten quite the tour of my home, from my study to my family room, my backyard, home gym, and now my money room. I figured this is the most appropriate room to film in today because in this video, we are going to focus on understanding money and the role of government in managing the nation's money supply and the economy overall. This will mean we also take a look at banking and the Federal Reserve System. These are some expansive topics with many interesting aspects, but I'll do my best to keep this short. Money refers to anything that serves as a medium of exchange, a unit of account, and a store of value. Medium of exchange means money is used to determine value during the exchange of goods or services. Unit of account means money is a method of comparing the value of goods or services. Store of value means money is something that keeps its value if it is held rather than used. So after a day, a week, or longer, money still has value. There are several reasons why money can have value, but its value depends on which type of money it is, so let's look at three types. Commodity money has value because even though it is used for exchange, it has value within itself. Like if people used corn as money, they could always just eat the corn. Representative money has value because the thing used for exchange represents something of value, even though that thing has no real value on its own. Like using paper money to represent gold, which is called having the gold standard. At least in theory, someone could exchange the paper for the gold, so the paper money has value. Fiat money has value because the government that creates it says it will be used for exchange. The fiat money has no real value on its own. It is valuable only because the government decides it will be used for exchange. Using representative or fiat money is a good idea because paper and coins have these 6 characteristics that commodities don't. Everyone accepts them for exchange. Paper, and certainly coins, last a long time. They are easy to carry around, can be divided into large or small units, have a standard value, and don't grow on trees. So when thinking about the US dollar, do you know which type of money it is? Yes, you are correct, I assume. It is fiat money. The US dollar has value only because the US government says that is what the country is going to use for exchange. I found that some people worry about this and think having the dollar on the gold standard would be better because the government needs to find gold and keep it in a vault in order to print more money. The concern with fiat money is that the government will print too much and therefore the money will lose its value. As there is more and more money printed, each individual dollar is not as special as it once was, so businesses want more money in exchange for the same goods and services. This phenomenon is called inflation. Inflation is a rise in prices, which is really the same as saying the dollar is losing its value. Generally, economists think an inflation rate around 2% is ideal. This means something that was $1 last year is $1.02 this year. A little inflation is good for an economy, but too much is problematic because it reduces purchasing power. Simply put, you can't get as much stuff for your money. Printing too much money is one reason for inflation, but there are several other reasons why inflation can happen. Having a gold standard appears to solve the problem of limiting the amount of paper money the government prints, but that is not really so. If more gold is dug up, then there can be more money printed. China and Russia are 2 of the top gold-producing countries, so they could change the value of any money on the gold standard by changing their gold production. Since the dollar is fiat money, that isn't an issue. The US has control over our own money supply. Another benefit of fiat money is that the government can directly influence the money supply to respond to the ups and downs of the business cycle, as measured by gross domestic product. This is the total value of all final goods and services produced in a country in a specific period of time. In a system of capitalism, because individuals have so much freedom to do what they want, the economy is prone to periods of boom and bust. Sometimes people make economic decisions that cause the economy to grow, so there are good things like new businesses, new goods and services, and more jobs created. Other times, problems happen that cause bad effects like businesses closing, people losing their jobs, and the stock market dropping. The coronavirus pandemic has certainly had a terrible impact on the economy, And as this article from the end of April shows, GDP has dropped since the start of the pandemic. The US government's role in our system of capitalism is to influence the economy to keep it healthy. Notice I said influence, not control. Total control is not possible in a system of capitalism. To really simplify it, the government tries to slow down the economy when it is overheating, meaning it is growing too quickly, and that will eventually result in a crash. And the government tries to assist the economy when it is falling to try to avoid a recession, or at least minimize how bad a recession gets. The two primary ways the government influences the economy is with fiscal policy and monetary policy. Fiscal policy deals with taxing and spending. Lowering taxes can stimulate the economy because people and businesses have more money to spend, and consumer spending helps businesses stay profitable, and this encourages them to keep people employed. Congress and the President manage fiscal policy. In response to the economic damage from the coronavirus, the US government passed a $2 trillion relief package to get more money to people and businesses. Monetary policy is used by the government to control the money supply so that prices remain stable and employment is maximized. This is managed by the US's central bank, which is called the Federal Reserve System, usually just called the Fed. The Fed also regulates financial institutions like banks and acts as the government's bank. Before diving into how the Fed manages monetary policy, it's necessary to understand the basics of banking. Banks are businesses that sell money and related services, and like any business, banks are trying to make a profit. Here's how it works. Steve puts his money in a bank for a few reasons. He believes his money will be safer in a bank as opposed to under his mattress. And because the government, through the FDIC, insures deposits, Steve is guaranteed to get his money back even if the bank closes. The bank also gives Steve access to his money anywhere. Like if he is on vacation and needs cash, he can go to an ATM to get his money as opposed to driving all the way home. Another reason is that the bank pays him to deposit his money. If Steve puts $1,000 in the bank and it pays him 1% interest, he is getting $10 just to put his money in the bank. That's a pretty good deal for Steve. Banks do some other beneficial things, but I think you get why people put their money in a bank. I put most of my money in a bank, but I like keeping some pocket change around the house. Now let's see why banks pay people for depositing money. Remember that I said banks sell money? Well, to do that, banks need money to sell. The bank uses the money people deposit to give out loans to people like Chloe. She doesn't have enough money to buy a house, so she needs a loan from a bank for $200,000. The way the bank makes money is by charging interest to Chloe, let's say at 3%. Just a quick note, the actual amount of interest received or owed would be quite different, but we are focused on the concepts, not the math, so I oversimplified this example. The interest Chloe owes is the price of getting money right now. In other words, Chloe is buying money from the bank for 3% interest. Notice the difference here. The bank pays Steve 1% for putting money in the bank, but it charges Chloe 3% for getting a loan. Banks also do many other things to make money, but I think this is enough explanation to get us back to understanding how the Fed uses monetary policy to stabilize the economy. The Fed is made up of a board of governors, 12 district banks that carry out the Fed's policies and oversee banks in their districts, and the Federal Open Market Committee. The Fed pursues expansionary monetary policy to help the economy when it's struggling, and it uses contractionary monetary policy to prevent the economy from overheating in good times. Since the coronavirus pandemic has been hurting the economy, the Fed has pursued expansionary monetary policy, so I'll only explain how that works. This will help to prevent confusion and keep this video short. There are three main tools the Fed uses to jumpstart the economy. First, the Fed uses open market operations to buy government securities from banks or other dealers. Due to the coronavirus pandemic, the Fed has done this recently. Second, the Fed lowers the discount rate, which is the interest rate the Fed charges to banks when they borrow money from the Federal Reserve System. The Fed has also recently done this. Third, the Fed lowers the reserve requirement, which is the percentage of a new deposit in a bank the bank must keep and not lend out. If the reserve requirement is 10%, The bank can loan out $9, but it must keep $1. However, the coronavirus pandemic caused the Fed to lower the reserve requirement to 0%. These actions by the Fed increases the money supply for banks, which then has a ripple effect that helps the economy overall. A key to fixing a struggling economy is to get money flowing. So when the Fed buys government securities, lowers the discount rate so it's cheaper for banks to get loans from the Fed, and lowers the reserve requirement, the banks gain access to more money, and the Fed funds rate comes down. This is the interest rate banks charge each other. The lowering of this interest rate causes banks to lower the interest rate they charge people and businesses for loans, and this makes people and businesses more likely to take out loans to buy things. Hopefully, these actions can get the economy to break out of recession. In short, the government gets banks more money, the banks then can make more loans at lower interest rates, and so people and businesses are motivated to get loans, which gets more money flowing in the economy. We've covered a lot of information about money and the government's role in regulating money and managing the economy. I'm Beat, and I don't want to complicate things, so that's all I have for you in this video. Of course, there are many related topics we didn't go over, but I hope you've gained a solid foundation so it will be much easier to understand these topics when you hear about them in the news. See you next time.